Before you believe the silver price on your screen, pause for a moment. Ask yourself one simple question. Is that number live, or is it just the last print from a market that already closed? Because while Western exchanges are frozen, real physical silver is trading elsewhere at a completely different price. That is not a conspiracy. That is market structure. And if you do not understand the difference between paper pricing and physical price discovery, you are not investing. You are reacting. Stay with me, because what is happening right now is not noise. It is a structural signal. When you open your brokerage screen and see silver trading at 93.66, it feels definitive. It looks official, settled, authoritative. But here's the critical question every serious investor must ask. What market is actually producing that number? That quote is not coming from a live, functioning global price discovery mechanism. It is the last recorded price from a derivatives exchange that closed Friday afternoon. COMEX is closed. The London bullion market is closed. The primary Western paper venues that set the benchmark silver price are not trading. For 34 hours, that number is completely static. Price discovery only exists when buyers and sellers are actively transacting. When an exchange closes, price discovery stops. The screen still shows a number, but the market behind that number is not operating. Meanwhile, the physical market in Shenzhen has remained open, and dealers are actively quoting $120 for real metal. That is not a theoretical future delivery contract. That is cash exchanged for a physical ounce. This distinction matters because futures pricing is based on contracts, agreements to deliver silver at a later date. Those contracts can trade in enormous volumes without a single ounce ever changing hands. The physical buyback price, however, reflects immediate supply and demand. A dealer quoting $120 is doing so based on inventory levels, replacement cost expectations, and real-time buyer demand. That is live economic activity, not a frozen derivative snapshot. The nearly 30% gap between $93.66 and $120 is not just a number. It represents a temporary disconnect between a closed paper system and an open physical system. Historically, when these divergences appear, convergence eventually follows. The only uncertainty is timing and the direction of adjustment. For investors, the educational takeaway is not emotional, it is structural. If you rely exclusively on exchange-quoted spot prices during periods of geopolitical escalation, you may be looking at a delayed signal. Markets do not pause simply because Western exchanges close. Capital continues to move. Risk continues to reprice. Physical transactions continue to occur in regions that remain open. The question is not whether $93.66 was accurate at Friday's close. The question is whether it accurately reflects conditions today while conflict escalates, oil routes face disruption, and Asian physical hubs remain fully active. In volatile environments, understanding which markets are live and which are paused becomes a core component of risk management, not a minor detail. If you want to know where the most honest price is during a market disruption, you have to ask a simple question. Where is real metal actually changing hands? The Shenzhen buyback price is not derived from a leveraged futures contract or a synthetic instrument layered with options exposure. It is a cash transaction in exchange for a physical ounce of silver. That difference is not cosmetic, it is structural. In Western markets, the commonly quoted silver price is built from futures contracts. These contracts allow participants to speculate, hedge, or arbitrage without necessarily taking delivery. In fact, the overwhelming majority of contracts are rolled or settled financially. This structure creates liquidity and efficiency under normal conditions, but it also means the quoted price can reflect positioning, leverage, and sentiment, rather than immediate physical scarcity. When those exchanges close, that mechanism pauses entirely. Shenzhen operates differently. Dealers there are quoting a buyback price of $120 because they are prepared to hand over cash for actual inventory. They are not trading theoretical supply, they are managing vault stock, replacement risk, and forward procurement costs. Every dollar embedded in that price reflects their assessment of what it will cost to replenish inventory in an environment of heightened geopolitical and supply uncertainty. That is why the refusal to aggressively sell at $120 carries real weight. Commercial dealers survive on turnover and margin discipline. They are not ideological actors. If they believed $120 was excessive relative to replacement value, they would be incentivized to sell into that strength. Holding inventory at record nominal prices signals an expectation that future acquisition costs may be even higher. That expectation is not emotional, it is balance sheet driven. There is also a geographic dimension that matters deeply. Shenzhen is embedded within the largest industrial demand center for silver in the world. Chinese solar manufacturing, electronics production, and electric vehicle supply chains consume significant volumes of physical metal. When dealers in that ecosystem lift buyback prices, they are responding to real downstream demand, not speculative inflows. In periods of stress, markets that involve immediate settlement often reveal conditions faster than leveraged derivatives platforms. The $120 Shenzhen quote is therefore more than a premium. It is a live signal from the physical supply chain. Investors evaluating risk exposure need to understand which price reflects theoretical positioning and which reflects actual metal moving across a counter. It is easy to attribute a sudden price surge entirely to geopolitical headlines. Missiles fly, markets react, metals spike. That narrative is familiar and emotionally satisfying, but disciplined financial analysis requires separating what is new from what was already building beneath the surface. In this case, the premium in Asian silver markets did not begin with the latest military escalation. It was already present, already widening, and already signaling tension in the physical supply chain. Before the weekend's conflict intensified, the Shanghai premium was running roughly $14 above international spot prices. That divergence was not driven by panic. It reflected persistent physical demand from industrial users inside China, solar manufacturers, electric vehicle producers, electronics companies all competing for available supply. These sectors are not speculative buyers. They consume silver as a production input. When they increase procurement, it tightens availability in measurable ways. At the same time, policy decisions added structural pressure. China's reclassification of silver as a strategic material and restrictions on exports altered the global flow of metal. When a major producer or consumer changes trade policy, it does not merely shift sentiment. It changes logistics, inventory movement, and replacement cost calculations. That type of adjustment creates a baseline premium even in calm geopolitical conditions. COMEX vault reports were already showing steady outflows, with registered inventories declining at a meaningful daily pace. Declining exchange inventories do not automatically trigger price explosions, but they do reduce the buffer between paper claims and deliverable supply. When inventories trend lower while industrial demand trends higher, the system becomes far more sensitive to shocks. This context matters because the $120 Shenzhen price is not simply a war premium. It is a war premium layered on top of an existing supply and demand imbalance. When two independent forces move in the same direction simultaneously, structural industrial demand and sudden geopolitical risk, price responses tend to be amplified rather than linear. For investors, this distinction changes the entire risk assessment. A pure geopolitical spike may retrace if tensions ease. A structural supply squeeze does not disappear with a ceasefire announcement. If underlying demand remains strong and inventories remain constrained, elevated prices can persist well beyond the immediate news cycle. Understanding that this premium was already embedded in the system before the latest escalation is critical to evaluating whether current pricing represents temporary fear or a deeper repricing of physical scarcity. When investors hear Strait of Hormuz, many immediately think in military terms: fleets, blockades, naval maneuvers. Financial markets, however, translate that geography into something far more direct. Roughly 20% of the world's daily oil supply moves through that narrow corridor. That is not a marginal flow. It is a systemic artery of the global economy. The moment that artery is perceived as unstable, energy markets do not wait for a full shutdown to react. They price risk instantly. Oil is not just another commodity. It is embedded in transportation, manufacturing, agriculture, plastics, chemicals, and electricity generation. A credible disruption, or even the credible threat of one, pushes crude prices higher through insurance costs, rerouting delays, and precautionary inventory building. Once oil moves, input costs across multiple industries adjust in parallel. This is how supply-driven inflation begins, not from excess consumer demand, but from constrained logistics and rising production costs. Historically, energy shocks have transmitted quickly into inflation data. The 1973 oil embargo demonstrated how even a partial supply reduction could drive double-digit inflation in the United States. Equity markets struggled under the weight of higher costs and reduced purchasing power. Hard assets, particularly precious metals, responded differently because they are not liabilities tied to corporate earnings or debt servicing capacity. They tend to reprice when fiat purchasing power comes under pressure. The present environment introduces an additional layer of complexity. Government debt levels are significantly higher than in prior energy crises. When inflation accelerates due to supply constraints, central banks traditionally respond with higher interest rates to cool demand. But aggressive tightening in a high-debt environment increases sovereign interest expense rapidly. This creates a genuine policy dilemma. Raise rates and strain fiscal sustainability, or tolerate higher inflation and risk currency erosion. Markets are acutely aware of this trade-off. For silver, the connection is not merely about safe haven psychology. Industrial demand for silver is tied to energy transition technologies, electronics, and manufacturing, sectors that can face both higher input costs and strategic stockpiling during supply disruptions. If oil volatility spills into broader commodity inflation, metals can reprice as both inflation hedges and essential industrial inputs simultaneously. The key financial insight is that a Strait of Hormuz disruption would not be a localized event. It would be a macroeconomic catalyst. Energy feeds inflation, inflation pressures monetary policy, and constrained monetary policy reshapes capital allocation decisions. In that chain reaction, assets perceived as stores of value often absorb the adjustment that traditional financial instruments struggle to contain. Here's the uncomfortable reality sophisticated investors are beginning to confront. Monetary policy does not operate in a vacuum. It operates inside a balance sheet. When national debt reaches approximately $38.5 trillion, and annual interest expense exceeds $1.2 trillion, every percentage point increase in rates carries fiscal consequences that extend far beyond inflation control. This is what is meant by the Federal Reserve being arithmetically trapped. In a traditional inflation cycle, the playbook is straightforward. Inflation rises, the central bank tightens policy, borrowing costs increase, demand cools, and price pressures moderate. That framework assumes the economy can absorb higher rates without destabilizing the sovereign balance sheet. Today, the scale of outstanding debt alters that equation entirely. A sharp rate increase does not merely cool consumer demand. It immediately increases government refinancing costs, expands deficits, and potentially forces additional debt issuance at higher yields. This creates a structural tension. If supply-driven inflation accelerates due to energy shocks or geopolitical disruption, the Federal Reserve faces two deeply unattractive options: tighten aggressively and risk amplifying fiscal strain and financial instability, or tighten cautiously and allow inflation to remain elevated far longer than target. Markets understand that this trade-off exists. Capital does not wait for policy announcements. It anticipates constraint. The bond market is particularly sensitive to this dynamic. When investors perceive that inflation may outpace policy tightening capacity, long-term yields can rise independently, reflecting inflation expectations and fiscal risk premiums. Higher yields in turn pressure equities through discount rate adjustments. The traditional 60-40 portfolio model becomes less stable when both stocks and bonds are simultaneously exposed to inflation risk. In such an environment, hard assets often attract attention not because they generate income, but because they are not liabilities. Gold and silver do not depend on corporate earnings, dividend policies, or sovereign repayment capacity. Their valuation tends to rise when confidence in monetary management weakens or when currency purchasing power is seriously questioned. For silver specifically, this dynamic compounds its industrial narrative. If inflation accelerates while policy response is constrained, both investment demand and strategic industrial demand can increase concurrently. That dual demand pressure is fundamentally different from a purely speculative spike. The critical insight is not that the Federal Reserve is powerless. It retains significant tools. The issue is that every tool now carries amplified side effects. When monetary tightening risks destabilizing fiscal sustainability, markets begin pricing assets based on policy limitation rather than policy intent. In that environment, repricing can occur rapidly and unevenly across asset classes. Geopolitical risk becomes materially different when it is concentrated rather than isolated. Markets have absorbed single conflict events many times before: a regional flare-up, a limited strike, a contained border dispute. These create volatility, but capital often treats them as temporary disruptions. What changes the equation is simultaneity. When multiple active conflicts emerge across the same strategic corridor, investors begin reassessing systemic exposure rather than event-specific risk. The corridor stretching from Iran through the Gulf region and east toward Pakistan and Afghanistan is not peripheral to the global economy. It intersects critical energy routes, mineral supply chains, and key trade infrastructure. When tensions escalate in more than one location within that arc, the probability of spillover effects increases significantly. Shipping lanes, insurance markets, commodity flows, and cross-border capital movements all become more sensitive. From a portfolio allocation perspective, uncertainty compounds when nuclear-armed states are involved. The presence of strategic weapons does not imply inevitability of escalation, but it does alter the tail risk distribution. Institutional risk models assign higher weight to low probability, high-impact outcomes when escalation ceilings are unclear. That alone can trigger defensive positioning across global portfolios. Safe haven demand historically responds to this type of layered uncertainty. Gold and silver have long functioned as assets without counterparty exposure. They are not dependent on a government's fiscal capacity, a corporation's earnings, or a financial intermediary's solvency. When geopolitical complexity rises, the appeal of assets outside the credit system increases meaningfully. There is also a regional capital flight component that often goes underappreciated. High net worth individuals and institutions operating within conflict-adjacent economies typically reallocate toward hard assets during periods of declared military engagement. That demand is not ideological. It is protective. It seeks stability amid potential currency volatility, capital controls, and market suspensions. When two active conflicts exist within the same geopolitical zone, the psychological shift in markets can be rapid. Investors move from evaluating whether this event will be contained to asking what happens if containment fails. That shift alone can widen risk premiums across equities, emerging market debt, and currency markets, while simultaneously strengthening flows into precious metals. The critical financial insight is that simultaneous conflicts increase correlation risk across asset classes. When geopolitical shocks overlap, traditional diversification can weaken. In those moments, assets perceived as independent of sovereign or corporate balance sheets often absorb defensive capital. That dynamic does not require panic. It only requires uncertainty at scale. Most investors underestimate what happens when markets are closed during a major geopolitical escalation. They assume price adjustment will be orderly, gradual, almost procedural. But markets do not process information in real time when the exchange gate is locked. Information accumulates, conviction builds, orders are prepared but not yet executed. When trading resumes, that stored pressure is released in seconds, not hours. Think about the mechanics: institutional commodity desks, macro hedge funds, pension allocators, algorithmic strategies, all of them are monitoring the same developments over the weekend. Oil risk rises, tokenized gold trades higher, physical silver quotes diverge from paper benchmarks. Risk committees hold calls, allocation decisions are made. Yet none of that capital can transact on COMEX until the opening bell. By the time Monday arrives, the decision-making is already complete. Only the execution remains. That compression effect is critical. Under normal conditions, buying and selling distribute across the trading session. Liquidity providers absorb incremental flow. Prices adjust gradually as bids and offers interact. When a major event unfolds during market closure, that natural distribution disappears entirely. Instead of staggered participation, you get synchronized action. Now layer in systematic strategies. Momentum funds react to price gaps. Volatility targeting funds rebalance when realized volatility spikes. Commodity trading advisors adjust exposure based on predefined signals. If silver gaps higher at the open, algorithmic buying can amplify the move before discretionary investors even have time to react. Mechanical rules accelerate momentum. Short positioning adds another layer of instability. Traders who were short silver at Friday's close cannot adjust during the weekend. If Monday opens significantly higher, losses are immediate and visible. Margin requirements increase as prices rise. Forced covering begins. That forced buying is not optional. It is a brokerage-enforced response to unacceptable risk exposure. In a relatively small market like silver, forced buying can create rapid and dramatic price extension. Retail participation often follows the headline. Investors waking up to gap moves and geopolitical escalation may enter through ETFs or online dealers. While retail flow alone may not move institutional markets, combined with professional reallocation and short covering, it adds incremental demand at precisely the moment liquidity is most strained. The key financial lesson is that timing matters enormously. When major developments occur outside trading hours, the reopening is not just another session. It is a concentrated repricing event. Liquidity can be thinner than expected, spreads wider, and volatility sharper than most participants are prepared for. Investors exposed to leveraged instruments must understand that the risk of a gap move is fundamentally different from ordinary intraday fluctuation. Silver is not just another commodity. It is a relatively small market sitting at the intersection of industrial demand and financial speculation. That structural reality is what makes short squeezes in silver uniquely violent. When positioning becomes imbalanced, the adjustment is rarely subtle. In futures markets, traders can sell silver contracts without owning physical metal. They post margin, a fraction of the contract's notional value, to control a much larger position. This leverage magnifies both gains and losses. When prices move modestly against a leveraged short position, the financial impact is not modest, it is multiplied. If silver begins to gap higher at the open, short sellers immediately face unrealized losses that erode their margin buffer. Here is where mechanics override opinion entirely. A trader may fundamentally believe silver is overvalued. That belief does not matter once margin thresholds are breached. Clearing firms calculate exposure in real time. If account equity falls below maintenance requirements, a margin call is issued. If additional capital is not posted immediately, positions are reduced or liquidated, and liquidating a short position requires buying the contract back. That buying pushes price higher. In a deep, highly liquid market, this feedback loop can be absorbed without dramatic price dislocation. Silver's market, however, is smaller relative to the global capital that can flow into or out of it. When concentrated short interest meets sudden bullish catalysts, whether geopolitical risk, inflation pressure, or physical supply stress, the forced buying dynamic can accelerate with stunning speed. There is also a psychological dimension layered on top of the mechanical one. As price rises sharply, discretionary traders who were neutral or mildly bearish often step aside, reducing available liquidity. Meanwhile, momentum-driven participants interpret strength as confirmation and add long exposure. The supply of willing sellers shrinks at the exact same moment forced buyers increase. That is a dangerous combination. Historically, silver has demonstrated episodes where price expansion occurs in compressed time frames. These moves are rarely linear. They involve sharp intraday spikes, widened bid-ask spreads, and rapid volatility shifts. For leveraged participants, this environment is completely unforgiving. Stop losses can trigger in clusters, compounding directional movement far beyond what fundamentals alone would justify. The essential financial insight is that leverage transforms volatility into obligation. A short squeeze is not driven by collective panic. It is driven by contractual rules embedded in margin systems. When those rules activate simultaneously across a concentrated group of traders, price does not drift upward. It reprices aggressively in a matter of minutes. At the core of this entire discussion is a question most investors rarely examine until volatility forces it. What exactly do you own? On a brokerage statement, exposure to silver can appear identical, whether it comes from a futures contract, an ETF share, a mining stock, or physical bullion held directly. Yet structurally, these instruments behave very differently when markets are stressed. Paper instruments are financial claims. A futures contract is an agreement governed by exchange rules, margin requirements, and clearinghouse mechanisms. An ETF share represents a fractional interest in a trust that itself holds metal or derivatives, subject to authorized participant creation and redemption processes. Mining stocks are equity positions in operating companies whose profitability depends not only on metal prices, but also on labor costs, energy inputs, debt levels, and management decisions. All of these vehicles function efficiently in normal conditions. They provide liquidity, leverage, and ease of access. Physical metal, by contrast, is not a claim on someone else's balance sheet. It is an asset without counterparty risk once it is fully paid for and in your direct possession. It does not require margin. It cannot be halted by an exchange circuit breaker. Its value in a local transaction is determined entirely by what a willing buyer will pay in that moment. That distinction becomes critically meaningful when trading venues close or when derivatives markets become temporarily disconnected from physical supply signals. This is not an argument that one form of exposure is universally superior. Each carries trade-offs. Paper markets offer tight spreads and immediate execution during trading hours. They allow hedging strategies and portfolio adjustments that physical holdings simply cannot match. Physical ownership sacrifices liquidity convenience but removes exposure to margin calls, forced liquidation, and certain operational risks that paper instruments carry. When divergence emerges between paper prices and physical transaction prices, investors are confronted with the practical implications of those structural differences. A futures contract can gap against a leveraged holder and trigger liquidation within minutes of market open. Physical metal held outright does not face that dynamic. Its price may fluctuate, but there is no brokerage requirement compelling immediate action. Understanding this distinction is part of genuine risk literacy. It requires moving beyond headline prices and examining settlement mechanics, counterparty structures, and liquidity conditions. In periods of geopolitical escalation and supply uncertainty, the question shifts from what is the quoted price to how does my specific instrument behave if volatility expands rapidly. That clarity often matters far more than any short-term directional forecast. Markets will reopen, prices will adjust, volatility will pass. But the investors who understand structure, who know the difference between leverage and ownership, between frozen quotes and live transactions, are the ones who stay in control. Do not chase headlines, study the mechanics, verify the data, and always know exactly what you own before the next opening bell rings.